The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A fourth straight day of gains, locking in the best week for U.S. stocks all year long. Live from Studio 2 here at Bloomberg headquarters in New York, I'm Raymond Boston.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S. It's been a relentless rally in stocks, and you see the S&P 500 above 6,000 after the Fed rate cut yesterday and consumer sentiment climbed to a 7-month high. We are seeing yields lower today, but still we're talking about a massive move since mid-September in yields, up about 70 basis points since that low. The dollar is moving higher today. It's higher on the week as well, and NYMEX crude losing about 2.5% right now. The latest China stimulus not exactly impressing investors.
Yeah, not impressing investors here, but maybe investors need a little bit of a reprieve here. The Fed, of course, has made its decision. The voters have made their decision as well, and companies have put their earnings cards on the table. You put it all together, and this week will go down as one of the busiest for financial market catalysts in quite some time, with the net effect of it all decidedly to the upside, at least for equities, with the S&P intraday cracking that 6,000 mark for the first time ever. The Dow right now punching through 44 grand, and even the Russell 2000 just 40 points away from reclaiming a record high it hasn't hit since 2021. Now, some of that upside confidence is indeed about the economic path forward, but a bigger part of it all was simply the removal of large event risk, something that is actually reflected in the VIX, the so-called fear gauge heading toward its biggest weekly point decline going back to December of 2021. That suggests investors see meaningfully lower market volatility in the weeks ahead. You know what else they're seeing? They're also seeing a meaningfully higher dollar, a cornerstone of the Trump trade. The Bloomberg Dollar Index up for a sixth straight week right now. Asset managers boosting their net long positions now for a fifth straight week. Here's what folks have to say.
The direction of travel is clear. More growth, slightly higher inflation, a higher public sector borrowing requirement, and a huge sucking sound where a lot of foreign capital will end up in the U.S. This is a period in which U.S. dominance of the global system is going to increase, both for positive reasons and for negative reasons.
And Scarlett, of course, this has probably been one of the more definitive reactions that we've seen to an election in financial markets. And it's probably going to continue, not necessarily up, but it's certainly going to continue once we get a better read here on what the policies are going to look like for the new administration.
Yeah, that's certainly the initial read coming out of the election results. And of course, the swift election, or re-election, if you want to call it, of Donald Trump this week ended weeks of uncertainty. Here's the price action that we've been seeing so far. It's pretty tight on Tuesday, and then the eruption of the Trump trade on Wednesday. A rally in stocks, which is yellow, it's stock futures, and the dollar, which is in white, and in the 10-year Treasury yield, which is blue. Now, yesterday, the Fed moved to cut rates by 25 basis points. Stocks, as you can see here in yellow, held on to their gains, while the dollar and yields moved lower. The 10-year yield for the week is set to end the week lower before a long weekend due to Veterans Day and remain, as you mentioned, stronger dollar as well.
Absolutely here. Of course, now we have to start to get to work in this country, and that's going to play a big role here in whether that trade does continue to the upside. Mona Mahajan joining us right now, senior investment strategist over at Edward Jones, helping us kick you off to the close. And Mona, we do have to start off with the election and the positioning in financial markets heading into this election, and now the repositioning, at least for some folks, that we've seen over the last couple of days here. Any sense here as to whether the price action that we've seen on Wednesday, Thursday, and today is going to be reflective of what we should expect over the next few weeks?
Yeah, it's a great call out. And look, you highlighted one key factor, which is the elimination of the uncertainty. That was first and foremost for the markets that were a little bit timid going into Election Day. Over the last couple of days, we have seen a definitive election outcome. We have probably seen a definitive Senate outcome, and we're heading towards that House result as well. So the good news is some of that uncertainty and some of that volatility, as you noted, has subsided pretty nicely over the last couple of days for investors. Now, what we're watching going forward is, one, what is this broadening of market leadership that we did see begin in the third quarter? What does that look like going forward? And in fact, a lot of the pro-growth policies that the Republicans have put forth, if some or all of them go through, we think that means a continuation of that broadening of market leadership. So we've already seen areas like small caps and mid caps play some catch up over the last couple of days. Sector-wise, we've seen some of those more cyclical areas, including industrials, financials, energy, all starting to play some rebound, seeing some rebound as well. We do think that that broadening of market leadership theme does have legs. Independent of what was happening in politics, we were seeing lower Fed funds rate, lower interest rates, as well as a broadening of earnings expansion driving that story. We think the addition of those pro-growth policies adds some fuel to that fire. Now, on the other hand, we also saw this trend of Treasury yields rising. Part of that was because economic growth was expanding, but part of it was because potential inflationary policies may be in play.
I am curious, absolutely, and I am curious, just to stay on the small cap side of this, particularly with the Russell finally within kind of spitting distance of a record high. It's a place that it hasn't been in for quite some time, and we've seen over the course of this year a lot of folks really looking for a broadening of that the market trade. It would sort of happen, and then it would kind of pull back for a couple weeks later. If this does indeed have legs, and we are going to hear from some of these smaller companies over the next couple of weeks as they start to report earnings, I am curious as to whether you think there's going to be enough confidence out there for the outlooks, and not just how they performed in the most recent quarter, but do you think that some of these executives will have enough clarity and confidence to guide higher for 2025?
Yeah, it's a good call out, especially on small caps, because look, that is a very highly leveraged part of the economy as well. They are very dependent on labor costs. Labor costs make up a big percentage of their cost structure. From our perspective, our kind of overweights in the cap space are in the large cap and mid cap space. We still, to your point, want to see a little bit more proof point on the small caps as they get through this economic cycle. Keep in mind, there's also a lot more of those quote unquote zombie companies or negative earners in that small cap space. So we do think if you're playing the broadening of market leadership, the mid cap and even the large cap space, both on kind of that growth value cyclical parts of the market, still make a lot of sense here. What we'd say more broadly is the earnings growth picture will drive, to your point, probably what the performance will look like in the year ahead. And the good news is we are looking at broader S&P 500 earnings this year slightly below 10%, but next year we could see double-digit earnings growth driven by those pro-growth policies, but also by a Fed that's moving rates lower and inflation that could be in line as well.
I liked what you said earlier, Mona, about how the price action prior to the election was kind of timid, which suggests that now people have a lot more conviction in buying up equities in particular. And I know that you recently upgraded the financial sector, Edward Jones, and you remain overweight in the industrial sector because of that cyclical factor. Are companies themselves likely to revise up their outlooks? We already heard from these banks and these industrial companies for the third quarter earnings season, and they didn't have that much visibility. Now that they do have that visibility, do you expect to see meaningful upgrades from them?
It is interesting. We all know kind of enacting real policy change takes time. The Tax Cuts and Jobs Act, for example, doesn't expire until the end of 2025. So in the near term, the new administration doesn't kind of transition until January 20th. So over the next few weeks and certainly over the next few quarters, we could still be seeing materially the same policy environment in place. So really what will be driving the economy and earnings during that period will continue to be how does the consumer hold up and how does the labor market hold up. And thus far, we have seen a resilient consumer driven by a labor market, still probably still holding up there at 4.1% unemployment, but certainly we've seen better supply and demand. Job openings have moved lower, et cetera. So this is still an economy, in our view, that has moderated from a very kind of outsized move in the post-pandemic period. Certainly not headed towards a downturn or recession, but a slowdown is likely. And I think that's probably what we're going to get over the next 2 to 3 quarters. And until we get that policy clarity and what's going to happen in place, that will probably be a 2026 story, if anything.
Got it. As we talk about a broadening of the equity rally, of course, there are a lot of other assets that are also getting caught up in the euphoria after the election, including Bitcoin, surpassing $77,000. We know there's a ton of money parked in money market funds right now. Is some of that money moving off the sidelines, and is it going into Bitcoin, or is some of the money going to Bitcoin being taken away from equities, perhaps not being allocated to equities and going somewhere else?
Yeah, certainly we continue to see an outsized amount of cash and cash-like instruments on the sidelines. I think the number is something like $6 trillion plus for money market funds. CDs we know are still there. Rates, as we've talked about, have remained relatively elevated, even at 4.3% 10-year Treasury yield, looking a lot better than really what we've seen in any time in recent history. Now, our recommendation, of course, is if you are sitting in a pile of outsized, cash, meaning cash beyond what you should be owning for your kind of next 6 months or so, this is a great opportunity, we think, still to kind of think about redeploying that into either allocations in equities and bonds. But if you're looking at the bond space in particular, investment grade bonds, adding a little bit of duration here, we think makes a lot of sense. We still think the crypto space remains speculative. We think generally speaking, think about the allocation strategically.
All right, great stuff, Mona. Going to have to leave it there. Have a wonderful weekend. Get some rest. Mona Mahajan, Senior Investment Strategist at Edward Jones, kicking us off to the close here on this Friday afternoon. When we come back, a closer look at the job market with freelancers and independent contractors making up 40% of the U.S. workforce. We're going to talk to the CEO of UpWork on trends in that space and why AI might actually be good for business.
Good for business. All right. Plus, Silicon Valley's big thumbs up reaction to Trump's White House return and what level of regulation they could be in store for. And a big focus right now on tariffs with the new administration coming in. We're going to talk to the CEO of one of the world's largest exporters of home textiles. You don't want to miss that conversation. So much more coming up in just a second, right here on The Close on Bloomberg. I recently had some time to spend in the city of Detroit, Michigan, a city that had been on hard times just a little more than a decade ago. A big revitalization taking hold there, led primarily by Detroit Mayor Mike Duggan. He talked about his efforts to revitalize the city and how he hopes to work across party lines with President-elect Donald Trump to get more done in the city. Here's an excerpt from our conversation.
We got a train station rebuilt because the mayor and the council work together. Mm-hmm. We work with Republicans and Democrats in the State House. We work with Republicans and Democrats in Washington. And Detroit's thriving because we haven't bought into the toxic politics. And we're perfectly capable of saying Donald Trump won. We congratulate him. And we're going to do our best to develop a working relationship. He promised repeatedly to do all kinds of things to make Detroit better. So hopefully he'll live up to that.
You did actually receive a lot of federal funding during the Trump administration for various infrastructure projects as well, more than $700 million. You received more than $2 billion, though, from the Biden administration. Are you concerned at all that you might actually see the federal contribution to this city decrease?
You know, the Detroit's recovery sped up by 10 years. For Joe Biden. The park we're standing in was built with American Rescue Plan money from Joe Biden. The lead pipes are being replaced with copper pipes because of President Biden. We got $1 billion in affordable housing. But this is the reality of what you do. We also have partners in Lansing that help us funding things. We also have millions of dollars in private donations. So my job is to find sources to rebuild this city, wherever they might be. But my relationship with Joe Biden was a 1 in a million. That's not going to happen again, but we appreciated it. We appreciated all he did.
And some of the conversation that I had with Detroit Mayor Mike Duggan on a Wednesday, he's in his third term, Scarlett, and the changes that have happened in Detroit are nothing if not remarkable. Obviously, a big part of that are some of the big money that's come in there. Folks like Stephen Ross, the Ilitch family, but also a huge contribution from both the state, the local, as well as the federal government. A lot of tax dollars have gone in to revitalizing that city. Absolutely. And of course, as other cities look to kind of do the same thing, revitalize their downtowns, they're going to be borrowing money in order to do that, which brings us to our Muni moment. U.S. voters approving about $52 billion of state and local government borrowing measures, ranging from education improvements to a transportation referendum. So joining us now is Bloomberg's Muni reporter, Nick Querolo. Nick, I know that California kind of stole the headlines with a pair of $10 billion statewide propositions, but give us a sense of what voters approved of.
Sure. So California was really kind of the story here. There were two massive bond referendums that both passed, not by a huge margin, but I think it was surprising because California is a high tax state. You know, the cost of living and inflation were really present issues in the election this year. It was surprising to us that, they were able to get these two really big bond measures passed, and it showed you how much California voters really are concerned about, A, climate change, and B, the state of their schools. But this was also a story nationwide, and we saw this in other states here, some of these referendums, and the idea that infrastructure and its importance to, I guess, the growth of the local economy. Talk a little bit about that. Absolutely. So we really pay attention to these bond referendums closely in the muni market. It gives you kind of a sense of how the supply is going to look next year. About 50 billion of 80 billion was passed. So that was really surprising to us. It was a pretty healthy degree of voters approving these types of measures, which tend to increase people's taxes. And also what was interesting to us was there were some pretty big rejections too. So Houston, for example, one of the biggest school districts in the country, was asking for $4 billion. That was handily rejected by voters. And it really just shows how kind of case by case and hyper local some of these decisions are based on kind of the needs of the community and what the economy feels like.
So put it all together, what does supply look like for the next couple of years? Because these are long-term spending measures.
Correct. So we saw a lot of issuers really expedite their borrowing plans to bring their bonds to market ahead of the election. October was one of the heaviest flow months for munis in years, and I think because state and local governments hate volatility, and they knew that this election would really throw fixed income markets probably into whack, and it has. We've seen a really big swing in this week, and investors are starting to kind of pare some of those losses we've seen, but this is going to bring a little bit of supply to the market that will kind of compensate for what was rushed to get out the door before the vote.
It raises the question, though, too. I mean, how much have interest rates factored into this? We've talked with a lot of folks heading into this election cycle about the drop in interest rates or the anticipation of a drop in interest rates and how that would affect issuance heading into 2025.
It's one of the interesting parts of the muni market. So unlike the corporate bond market, muni issuers tend to not be very interest rate sensitive. These are plans to build a new bridge or to repave a town's roads that usually are started at a council meeting, and they take years to plan. They don't have the kind of flexibility that a company might have to bring projects to market when the interest rates are comfortable for them. So I don't anticipate seeing very much change due to the kind of interest rate fluctuations. More so, a lot of this stimulus money that you were talking about is starting to roll off the books of these governments. They're going to start to need to find some new sources of capital to, fix the infrastructure that always needs upgrading.
All right, and of course, I'm sure you'll be all over that. Municipal bonds reporter Nick Querolo here, a closer look here at maybe a potential shift here in the landscape of municipal finance. When we come back, we're going to focus on big U.S. banks and some of the optimism around some of those names from concerns about some of the regulations we saw during the Biden era and the potential for some of those regulations to ease in the Trump era. This is The Close on Bloomberg. All right, let's get a view from the sell side. Top calls, big movers on the back of analyst recommendations. And we start off today with TAP, Molson Coors. Cheers to a double upgrade to overweight from underweight. This over at Wells Fargo with the analyst saying the beer company in a much better position heading into 2025. Given the outlook for profit growth and the stock's historically low valuation, the price target going to 74 from 52. The analyst saying the stock could really get going. Shares up 5% on the day. Next up, let's take a look at Home Depot. A lift to outperform over at Telsey Advisory. The analyst there, Joe Feldman, saying yesterday's interest rate cut should spur consumer spending, including in home improvement. He also cites increased confidence that Home Depot can return to solid sales and earnings growth next year and beyond. We should point out Home Depot actually reports earnings next Tuesday. And finally, Bank of America getting an upgrade to buy from neutral. This over at Citi. The analyst there, Keith Horowitz, saying that the valuation spread among U.S. banks is relatively wide, and he views Bank of America as the best liquid way to play an expected convergence in the sector. He says Bank of America is a low-risk company and sees potential for it to benefit from a lighter regulatory environment under a Trump 2.0 term. Shares there up about 1% on the day, not far off its record high, I believe. We do want to stick with banks and stick with the sell side here because the mood around regulation, at least for financial companies, has certainly improved. Cautiously optimistic, if you will, in the wake of President Trump's victory, basically a re-election. The incoming Trump administration is expected to appoint more industry-friendly regulators, leading to a less restrictive environment for some of those banks. Sally Bakewell joining us right now, who leads our finance coverage. And Sally, this is really the scuttlebutt right now here, is that cloud, that regulatory cloud that has been over these banks for quite some time. You're expecting that to ease?
Yeah, that's right. I think the great expectation under a Trump administration is that he looks at financial regulation and both dials back specific regulations and narrows the scope of some of the agencies that oversee things like M&A. And one of the biggest pieces of the bank regulation story is Basel. These are the proposals that would, under the most recent plans at least, force the biggest banks to hold about 9% more capital to cushion them against financial shocks like the financial crisis. Now, as we reported today, some senior bankers and industry executives think that there will almost certainly be a delay in implementing these. And since we have yet to even see a final proposal, and that maybe the Trump administration will actually not progress with these proposals at all.
Yeah, so the capital rules is like first on the list in terms of things that might provide a tailwind to these banks. The other, as you mentioned, was M&A. And when we talk about M&A, it's not just mergers and acquisitions overall allowing for banks to earn fees, but also consolidation within the industry too.
Yeah, that's right. I think one of the biggest things here is how a lighter touch regime, as expected under Trump, could unleash the deal-making machine, accelerate capital markets activity. And we had the Querolo Weinberg CEO, Andrew Bednar, say today that under the current regime, deals can take as long as 12 months to close, which really upsets the risk-reward equation. And this indeed, is a big driver of the bank's share prices this week, the expectation that Trump's tariff policies, his more business-friendly approach, a softer anti-touch rate and anti-trust regime could really fuel M&A and also make bank tie-ups a little bit easier. And that could, in the regional banking sector, survival is sort of pinned for some on the ability to merge. So we'll be watching very closely for whether we see that kind of activity pick up under a Trump administration as well.
Absolutely. And then on that point, too, as well, there's been some discussion about this idea of kind of those bigger banks not only not being out from under, or at least maybe being under a less restrictive capital rules, but the idea that that could actually increase the amount of cash that they're able to return to investors, whether through buybacks or dividends.
Yeah, that's right. I mean, a big complaint of the banks actually about these proposals was that whatever they have to allocate against, financial shocks and riskier activities is something they can't allocate elsewhere, which could be from shareholder-friendly activities like dividends and buybacks, but also lending. And they often used a more emotional argument, saying that this would sort of inhibit their lending to minority borrowers, for example, and mortgages. But now, if they do end up having to put less capital aside, or even and no hike at all, which we don't know yet, we'll have to see how that progresses. This could enable them to free up a bit more money that they can put toward those purposes.
All right, Sally Bakewell, who leads our finance coverage here at Bloomberg News. Thank you so much. Coming up, we're going to get a read on the growing segment of the U.S. labor market that is independent contractors from the CEO of UpWork. This is The Close on Bloomberg.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Scarlett Fu, and I'm kind of stunned just by how much has changed over the course of a week, because last week at this time we thought we might not have an answer to the election until over the weekend, and that has not been the case at all.
Yeah, we were kind of preparing for what was going to be, we thought, several days, if not weeks of vote counting and legal challenges. Of course, that was all put to rest late on Tuesday night, early Wednesday morning when we started to get those battleground state results in. But obviously now it kind of turns to this whole idea of what are the policy impacts going to be on our economy and on, of course, the labor market.
Yeah, although investors are getting ahead of themselves, of course, and anticipating.
As they always do.
Yes, exactly.
Yeah.
Well, we can return to the fundamentals and the economic fundamentals, which includes, of course, data on the labor market. And a new report today from the Bureau of Labor Statistics finds about 1/10 of the U.S. labor force, that's roughly about 15 million people, work as freelancers or independent contractors. A slight uptick from 2017, the last time the BLS reported on this group. Now, this population uses platforms like UpWork to navigate freelancing opportunities. Earlier this week, UpWork raised its full-year revenue forecast. So joining us now is Hayden Brown, President and CEO of UpWork. Hayden, it is good to speak with you. We've seen how different reports show that the U.S. labor market has certainly softened lately because of weather events and because of strikes, but is still holding on. It is in good shape. Hiring may be slowing, but layoffs are not exactly surging either. How's that reflected specifically in what you see going forward for UpWork in your forecast?
Yeah, thanks for having me, Scarlett. What we are seeing on our platform and in the freelance economy overall is, there's been a surge for many, many years in the popularity of freelancing, as you mentioned, but we're also seeing, a lot of headwinds in terms of overall in the economy, inflation and interest rates dampening the spend from small through large businesses overall. So that's coming through in terms of less than normal hiring for contingent workers, for staffing. And on our platform specifically, we've outpaced this trend. We saw 17% year over year growth in the first half of this year, whereas the staffing industry as a whole was down 8%. So this speaks to, I think, the attractiveness of our value proposition and the freelancing economy. But it's a tough market out there. It's choppy. I think it's going to continue to be that way for a while because these trends around interest rates and inflation have been compounding for quite some time, and businesses are still feeling that pinch.
Yes, they are. And as Raymond just reminded us, even as we get a new administration, it will take some time for new policies to be put in place. So when it comes to the freelance economy and the freelance population, how much pricing power does this group have? What do their wage increases look like versus, say, a year ago or versus, say, full-time employees of companies?
We typically see on our platform annualized raises in wages by freelancers who do negotiate their own raise. So they're in charge of how much they want to charge clients. And that does typically increase year over year, although in the last year or two, those increases have been smaller. The exception to this has been freelancing talent who have AI skills. And as you can imagine, this is an area that's very hot right now. We saw AI-related categories of work driving a 36% growth in spend in that area for our business in the last quarter. And freelancers who have AI skills are actually able to charge a 40% premium versus freelancers who don't have those skills. So this is really the new trend, and I think it's here to stay. This is going to be powering freelancers, this year, next year, and in years to come.
What's the type of expertise, though, specifically on the AI side that those employers are going to be looking for?
They're looking for people who can train models, who can do prompt engineering, but also they're looking for knowledge workers with very high skills in kind of esoteric areas. So it might be chemistry engineering, but also knowing a very exotic language. So this is where the intersection of professional skill sets in a variety of areas, a variety of places, but that now people they've gone from, very basic data labeling and image labeling. That was kind of hot 2 or 3 years ago. Now they're looking for PhDs and experts who have highly skilled knowledge work skills that they really can't find in the broader market. And they're looking for these people in large numbers.
I am curious, though. Of course, the flip side of that, I'm sure there's obviously a lot of concern about the potential negative impact that AI might have on jobs. There are a lot of folks on that platform that are advertising services that, quite frankly, at least certain forms of AI can replicate, not necessarily well, but certainly can replicate them. How do you sort of address those folks on the platform who are worried that maybe someday these AI tools get so good that they can replace some of what they do?
Yeah, Raymond, this is an important topic. And I think what we're seeing is the myth and the reality are very different. The headlines are out there saying AI is taking away all these jobs. The reality on our platform is actually AI is creating a lot of jobs. And also freelancers who have AI skills are able to do more and to charge more because of that. We're also seeing that in general, folks who are learning these new skill sets are getting more efficient, they're getting more effective, and using AI tools, they're actually doing work they enjoy more. So they're offloading a lot of the cognitive stuff that wasn't that fun, that they didn't enjoy doing, to AI, and are actually spending more time on creative work, on strategic work, on interpersonal sides of jobs. And that's actually a huge silver lining of what AI is bringing to the table. So the myth and the reality are very different. AI is not replacing a lot of work or even a significant portion of work at all on UpWork. It's a few marginal areas where that's happening. AI is really augmenting and enabling people to do more of what they love.
I'm curious, those professionals with those AI skills that are in such demand, is it more worth it for them? Can they make more money staying independent, working on a freelance basis than to be hired by a company full time?
Scarlett, this has been a big shift actually over the last decade or so, if not a little bit more, since the 2007-8 recession. What we've seen is it used to be that people were freelancing quite often out of necessity, and they felt like they had to do it because they had gotten laid off or they didn't have another option. Actually, as we've surveyed folks over the last few years, increasingly now they're doing it by choice. They're doing it because they actually feel more safe and more secure freelancing because they feel they control their destiny. They have 4 or 5 secure clients, so no one of those clients can lay them off and then suddenly leave them out in the cold. So there's been a big shift in the freelancing economy where now this is actually a preferred way of working. You think about the creator economy. This is really the new way that people want to build their careers and have choice and autonomy and not be beholden to just one single employer.
And I'm curious, do you anticipate that we could see that trend accelerate a little bit, primarily because of the outcome of the election? And I don't necessarily want your opinion on what happened on Tuesday, but we did see a trend, of course, coming out of the pandemic, and we did see it during one of the last elections, where there did seem to be a gravitation of some folks to what you said was a more, I guess, if you will, independent type of work career path.
Romaine, I don't know if the election outcome will be driving, an increase in freelancership, but we do see already 64 million Americans freelancing. It's a huge part of the economy, over $1.2 trillion created. And I think with the rise of AI, more and more people have available to them the tools and technology to build their own business, to stand up a website, to start a digital business that maybe before was out of reach for them because the skills required to do that, took many years to learn, going to school, et cetera. And now with AI, they can do that much more quickly. They can hire someone on UpWork. That person with an AI skill set behind them can do a lot. So I think these are the fundamental tech trends that are going to enable many more small businesses, many more freelancers. And this is very exciting.
All right, Hayden, always appreciate you taking time for us. Hayden Brown, she's the president and CEO of UpWork. And, we talk about this idea of people taking ownership of their career in a way. Some of us choose to work for corporations, and there's a lot of safety and stability that comes with that.
And health insurance.
Right, and health insurance. But as she points out, there are a lot more options today for folks to be able to take these career paths, and people want those options. They want the flexibility to be able to work from home or be able to deal with childcare issues. And
no, the pandemic taught us that, and that was really clear. But I guess it's worth mentioning as well that something like Obamacare has also enabled freelance professionals to take on several jobs and not really have to worry as much about where their benefits are coming from, especially in health insurance, because they're covered that way.
Yeah, for now.
For now.
All right, coming up, we're going to take a look here at what's going on with some of the online travel companies. You're seeing a lot of activity there. You see that in Airbnb and Expedia here. We're going to talk about what the earnings that we've got out of a couple of those companies actually says about the strength of consumer travel. A bit of a mixed message in our stock of the hour. It's coming up next, right here on The Close on Bloomberg. A lot of activity among travel stocks today, particularly online travel companies like Airbnb, Booking Holdings, and Expedia Group. They all issued stronger than expected outlooks in their recent earnings results, all suggesting that demand for travel isn't actually slowing down just yet. Bloomberg's Abigail Doolittle joining us right now to talk a little bit more about what's going on. Of course, we know we had the big revenge travel boom here, and there was a lot of concern here. We were going to start to see that taper off. Let's start with Expedia here. Stock is doing pretty well. They get a huge chunk of the revenue comes from the U.S. market here. So a pretty good barometer here on U.S. discretionary spending.
It is a good barometer on U.S. discretionary spending, and especially they're talking about strength here for the fourth quarter. The quarter that they reported was actually a little bit mixed. They missed on, there was mix between earnings and sales. There was a big beat on gross bookings, so that's what folks like. But also looking ahead to the fourth quarter, they're talking about the idea that the demand is solid. So to your point, yes, and the idea that the revenge travel is not down. That's an important one because we've been watching all these mixed signals on the consumer. Are they spending? Are they not spending? Apparently, Americans are still willing to spend on experience. One piece that was really highlighted, the Vrbo, in terms of, is that how you say it?
Yeah, I think so.
Okay, yeah. So Vrbo, that was
just like it's spelled.
Yes, that's what I was assuming. That is a piece of strength. Apparently, it's been a little bit tough for them, but one analyst saying that it's quote unquote on the mend. That leads us to Airbnb, which this one is all over the map because I actually reported on this, broke these earnings yesterday. Initially, it was up like 13% because they beat earnings. Their nights booked growth for this current quarter better than the estimate, and now the stock is down 8%. Yeah. So this stock has really flipped around by.
But this is why? Because that's, 10% growth, great, but that's a deceleration.
Well, it's a deceleration, but it was better than what the street was. The street was closer to 7.5 or 7.7%, so it was better. But the real thing there is they are spending to grow, and that's going to weigh in margins. So investors not liking that. I always call that the Amazon effect. Back in the day, Amazon used to spend and kind of blow it very quick.
But you know what? It paid off for Amazon, and investors can attest to that. So when it comes to Airbnb, it feels like they're very much tied to big events. Like the Summer Olympics in Paris was very much a benefit for them. And when there are those big events, that's when they really shine.
That definitely was a piece for Paris and the Olympics, but in terms of overall demand, I guess the question is, so I personally am not an Airbnb person.
Oh, yeah?
I don't know about the two. I would much rather stay in a hotel. So it's a matter of, is there going to be long live demand for this? And I think that there probably is. But in terms of growth, can they continue to grow it? Can they turn me into an Airbnb user and the other non-Airbnb?
Yeah, you do kind of wonder if they
kind
of hit critical mass or something at some point. Then you have local regulations. But I don't know, it depends. I mean, I generally prefer a hotel too. I don't know about you, Scarlett.
I like an Airbnb if I'm traveling with my family.
Yeah, you got
exactly.
a big jump group of people with you. Sometimes it's more economical to do
Absolutely.
that.
And oftentimes you need a car, you need a place to park the car. The hotel doesn't allow for all of that. So I go to California a lot, so that's why it's an issue.
Oh, okay.
You don't travel with lots of people that require a car? Come on, Romain.
I try not to.
Romain travels solo. All right, Abigail, thank you so much. Abigail Doolittle with today's stocks of the hour. Coming up, we're going to count you down to the closing bells with Nguyen. She is partner and CIO of equity strategies at Research Affiliates as the S&P 500 looks headed for another record close, just below 6,000 at the moment. This is the close on Bloomberg.
We do think that broadening of market leadership theme does have legs. Independent of what was happening in politics, we were seeing lower Fed funds rate, lower interest rates, as well as a broadening of earnings expansion driving that story. We think the addition of those pro-growth policies adds some fuel to that fire.
Mona Mahajan, Senior Investment Strategist at Edward Jones. She kicked us off to the close just about 50 minutes ago. I thought it was kind of interesting, her comments here about the broadening of the market on a day where we are seeing modest outperformance by the Russell. But more importantly, the Russell actually for the first time in since 2021, actually within spitting distance of a record high.
I know. We had kind of given up on that idea for most of 2024 because every rally never really lasted more than a week at most. You know, it's so interesting. We've gone from, all these event risks to no event risk on the horizon.
I know. That's kind of interesting. I was thinking about that too because, I mean, it seemed kind of subdued, the price action today. Then I was kind of looking ahead to the next week, like what to prepare for. Yeah. And I was like, there's nothing to prepare for. Like it's all over, right? I mean, earnings season is winding down. The Fed is done, and and we have an election outcome already. So 13 Fs. Thank you, Scarlett. All right, always holding on to something. Record highs, at least for the Dow, the Nasdaq, and the S&P on this day. The Russell 2000 at one point was above that 2,400 level, actually coming just about 40 points away from almost time high. Let's keep it moving here as we move closer to the closing bells here in New York, closing out what is going to be a relatively phenomenal week for U.S. equities. Nguyen is partner and CIO of equity strategists at Research Affiliates. She joins us now around the desk here in Studio 2. And Nguyen, I do want to talk about kind of the wake-up reaction coming out of the election. I think a lot of people had already positioned in this market for the outcome, let's just say. Some had it right, some had it wrong. But we saw the activity on Wednesday. I'm sure you saw it. Just kind of encapsulate what you think that trading activity was most about. Because it wasn't just blanket, we're happy Trump won. There are some ramifications here that could have some really positive benefits for some of these stocks.
Yeah, I think that one of the things that was really interesting was that the race wasn't even close, right? It was a closely contested, or at least perceived to be closely contested election. Once it became clear that it wasn't even close, there was a decisive winner. I think a lot of the rally was a relief rally. And you actually saw strong price action across the board. But clearly, people are now focused on what's next, right? What does it really mean to have a Trump administration? There's going to be different opinions about what he's going to do, but clearly there are two things that he really wants. He wants lighter regulation, and he is a protectionist, right? So I think those are the things that we have to really think about in terms of the pros and cons leading into the market.
What's that balance going to be like, though? Because when I hear lighter regulation, I think, there are a lot of industries, tech, financials, that would outperform on that. Then when I hear protectionism, I think a higher dollar, and I think some other negatives that could actually sap some of those profits.
Yeah, sure. I think that if you're looking at the combination of lighter regulation and more protectionism and a stronger dollar, what you're really looking at is high quality small cap stocks, right? Because those tend to be more domestically focused. They tend to have a harder time bearing the cost of regulation, right? And of all these requirements. You see that across the board. This is one of the reasons why there are fewer and fewer small cap stocks being listed in the US than there were, say, 25 years ago. And so small cap is an interesting one because one of the things that you were just talking about was it was a trade that everybody had given up on. It was massively oversold. Nobody was expecting it, but it's dirt cheap. And in the last few weeks, months, you've actually seen some life in these companies. They actually are delivering on their earnings. They're extremely cheap, and people who are tired of just owning NVIDIA all the time or the most highly priced stocks, they're beginning to look at some of these bargains.
So when you say high quality small cap companies, what are the characteristics of them? I know you guys can look at it from a bottom up approach and do your homework and, sift through them, but are they, do they belong to a certain sector? Do they have certain qualities that they share in common?
I think the thing that we're really looking at is are companies that have a manageable balance sheet. I think one of the things that gets small cap stocks into trouble is when they're over levered, right? Because they're highly sensitive to interest rates. One of the things that we're seeing with Trump is that he's a free spender. I mean, it's not as if the Biden administration weren't free spenders, but if interest rates are going to stay higher, then companies have to be aware of these borrowing costs, being able to roll over their debt. So companies, not necessarily with no debt, but companies with a manageable level of debt relative to their revenues.
Fortress balance sheets, in other words. So I want to go back to what Raymond said, which is, how you kind of think through everything now that we have an election outcome, a clear election outcome. I know that in the news business, we will be paying attention to every time he holds a news conference because in the past, in Trump 1.0, he often dropped hints of policy or what he preferred in those news conferences. And then we would try to get expert opinion to kind of tease out what that means. Is that what you'll be doing from your end as an investor as well?
Not necessarily. I mean, I think from our end as an investor, we're really focused more on the fundamentals of companies. I mean, I think that these end effects of what the policies are often second order to what's actually happening with the companies themselves, right? Because just because he says, I'm going to have lighter regulation on financials, not every single financial company is going to perform in the same way.
What about some of the tech stocks? I mean, there's been a lot of talk about sort of overarching AI regulations. I believe, and someone could correct me if I'm wrong, but I believe Trump on the campaign trail said that one of the first things he would get rid of course, is the rule that came out of the Biden administration. And I assume any sort of meaningful regulation out of Congress on AI is pretty much dead at this point.
Yeah, I think that's probably true. And I think it's not just AI, right? It's also crypto. I mean, you're seeing the reaction in Coinbase and also many of the coins themselves. So in some ways, it's really great for innovation, right? People want to be able to innovate without worrying about getting into trouble. People want to be able to take risk. And I think that's really, really good in the short run. And I also think that that's going to be good for a broad variety of tech stocks, right? Not just the big household names, but some of the ones that kind of are not as exciting, right? Companies like Qualcomm, Intel, because as it broadens out, more and more capacity is going to be needed in the tech sector.
What would you avoid in this environment?
What would I avoid in this environment? I would have to say companies that are highly exposed to China. I mean, one of the things that you're already seeing is companies that are highly dependent on this China supply chain, they could have a lot of issues. I think Madden was the one that basically said, we're getting everything out of China. Yeah. Big companies like Apple, they're going to have to shift things around, find ways around that, and they have the ability to do that. But small companies that are highly exposed to that, I think, could suffer. Yeah, it'll be interesting. At least the big companies have had a little bit of a head start, a little bit of a test run, if you will, of course, because of what's happened over the last 6 or 7 years. Quay, we're going to have to leave it there. Always a great conversation. Quay Nguyen is a partner and CIO of Equity Strategies over at Research Affiliates, helping us count you down to those closing bells. Those bells just about 2.5 minutes away, sitting on record highs. And I don't know if we're going to hit that 6,000 level on S&P 5. I did not print out a hat for this, but we did crack it on an intraday basis, Scarlett.
You had a 3D printer at your desk with a 6,000 hat?
It's a new world, Scarlett, for innovation. All right, we're going to break down all of the market action on the day and really on a very wild week, so stick around. Full market coverage coming up right now on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostic here alongside Scarlet Fu, taking you through the closing bell of Global Simulcast. It starts right now. Tim Stenovic joining us from the radio booth. Jess Minton by his side in today for Carol Massar as we welcome our audiences across all of our platforms. That includes our partnership with YouTube. Tim Stenovic. Record day for the Dow. I know you love the Dow. You're an old economy guy.
Hey,
record day for the
special.
S&P 500. And look at this. The Russell 2000, Tim, at one point came about 40 points away from getting a record high.
It's pretty remarkable to see. Just think about how much different things were a week ago, guys. How much uncertainty there was out there. There was a lot of concern that we'd be sitting here a week, later, that we wouldn't have a presidential choice. It wouldn't be a clear victory for either party. Well, look, it was a red wave, and investors certainly like that. We're going to see maybe the best week for the S&P 500 in a very long time, Jess.
And of course, Romaine just brought up when it's looking at small caps, Russell 2000. But if you look today, it's actually November 8th. On November 8th, 3 years ago, so in 2021, that was the last time that it actually had hit that all-time high. So it's been a tough stretch there for small caps, but it'll be interesting to see also the trajectory of what happens with rates now, because that's obviously highly indebted, more domestically focused companies. So when investors were thinking we'd see more rate cuts next year, now they're bringing them back in depending on what happens in Washington and policies, guys.
Yeah, to Tim's point, event risk has pretty much disappeared. It's concluded, and you see a surge in volume as well. Volume in the Dow is 38% above the 20-day average. Now, we should note that the Dow is no longer so old school. It does have NVIDIA, after all, starting today.
Yeah, it's getting there. It's catching up with the times. Good to see they're still sticking by just 30 stocks here as a representation for the entire economy.
And price-weighted.
We should also point out that here, when we talk about what a wild week it was, the VIX having one of its biggest point drops on a weekly basis in quite some time, showing that at least the outlook here for volatility has certainly been tamped down. A lot to cheer about on the day and on the week. BlackRock ringing the bell there over at the NYSE as the Dow Jones Industrial Average closes out the day just below that 44,000 mark. It did trade slightly above that earlier in the session, but still up about 0.6% record high. The S&P traded slightly above 6,000 as well, going to close just below it at 5,996. Up about 0.4%. The NASDAQ up fractionally by about 0.1%. Look at the Russell 2000, only 17 points added, only 0.7%, but at 23.99 and change, Tim, it is now the closest it's ever been to reclaiming that record high in about 3 years.
Well, let's take a deeper look in the S&P 500. Peeling back the layers, 317 stocks did move higher in the S&P 500. 184, Scarlett, moved lower today.
And of the groups that did advance, 5 of them climbed at least 1%. So you had utilities, real estate investment trusts, and consumer staples, more of the defensive sectors, gaining all at least 1.5%. On the downside, materials, communication services, and tech actually did finish in the red.
All right, let's go to some of the gainers that I have for you today. I do want to start with Tesla. Shares of Tesla popping today by more than 8%, and that brings it to a market cap of more than $1 trillion in value for the first time, going all the way back to 2022. Investors continue to bet that Trump's return to the White House can be a positive force for the company, considering his now very close relationship with Elon Musk. We did see that shares closed just about 30% higher just this week, guys. So really a big move for Tesla so far this week. Huge.
Can I just say, too? Because I mean, and I don't want to get too into politics, but this is going to go down.
I'll play.
As probably one of the biggest gambles, right, that he made. Because there was a lot of people that when he aligned himself with Trump, I'm talking Elon Musk, they were saying, okay, this guy's, bad idea. But obviously, this is going to be a huge benefit for him, assuming he stays in Trump's good graces over the next 4 years.
Well, I wonder how that benefit will manifest. Look, I think you're right that it was a huge bet, and it was one that instantly became clear was a winner, at least for Elon Musk's personal
potentially
fortune.
Lower regulation on the EV side, potentially an acceleration of robo-taxis and other things that are going to require some sort of government involvement. Obviously, he's got SpaceX, which is pretty much just a government contractor at this point. So, yeah, I mean, obviously no promises, but I mean, you can see where this is going to go.
And maybe a side gig as well, right, at the government.
Maybe if he wants that. I mean, Department of Government Efficiency, DOGE, right, as we've heard about and he's talked about. But at the same time, if you look at the history that Donald Trump has had with people who have been close to him, it has sometimes been tumultuous. I wonder if...
Yeah, we're not talking about that just yet.
Look,
it's optimism week here, Tim.
It's still the honeymoon period,
we'll
right?
get there. We'll get there at some point. But yes, your point is taken.
Okay, let's talk a little bit about Axon Enterprises. It's a parent company that makes police gear, including body cameras and tasers. Shares of Axon Enterprises surged today, higher today by more than 26%, higher by more than 28%. Look at that, almost 30%
What's going
higher
on?
this year.
Are we tasing more people or something?
Well, the company did raise its full-year outlook after third quarter results beat expectations. They also touted this AI era plan. I'm not going to make a Taylor Swift eras joke here, but for Axon, the taser maker, it is the AI era. Investors obviously are excited about that, sending shares higher by close to 30%. We saw at least 8 Wall Street analysts raising their price targets for Axon shares, data compiled by Bloomberg show. And one more on the President-elect. Trump Media and Technology shares moved higher today by more than 15%. They were a little all over the place today. There was a volatility halt. The former president and president-elect did send out a post saying that he has no plans to sell shares in it. The company also earlier this week, we should note, disclosed that it had lost $19 million in the third quarter on revenue of just $1 million. Net losses piling to $363 million in the first 9 months of the year. The valuation is more than $6 billion. Many people do argue this is detached from fundamentals.
Well, since I'm wearing red, guys, I'll go ahead and take those decliners. So the worst performer in the S&P 500 today, Akamai Technologies, actually falling after its results and lowering its outlook when it comes to its profit forecast. Also, if you look at its stock, down 14%, worst day since July 2017. This is a computer and internet technology consulting services company. Its market cap's around roughly $14 billion here. If you look at the A&R function, it has 15 buys, 8 holds, and 1 sell. Moving over, though, looking at Pinterest. So this, of course, reported earnings after the bell yesterday, also down 14%. Pins is the ticker symbol on this, worst day since July 31st here. Of course, the image sharing platform sank after weak ad trends were weighing on its revenue forecast, specifically for the current quarter and the fourth quarter. Morgan Stanley analysts flagged weaknesses in food and beverage ad spending. So that's what's weighing on that stock. And then finally, Sweetgreen, ticker symbol SG on this, down about 6%. Worst day since October 17th. So just a few weeks ago was that worst day, but the market is punishing it after Salad Chain actually reported a wider than expected loss for the third quarter. Unfortunately, the results failed to meet those high expectations, guys.
All right, let's take a look at yields here because we did see a lot of activity there, but forget what happened on Wednesday. Remember, you had that huge pop in yields on the back of the re-election of President Donald Trump, but that actually faded. And right now, we're talking about yields once again actually moving in the direction that a lot of people, well, weren't betting on. In fact, we're actually closing out on the 10-year yield at 4.3%. That's below where we were last Friday here. We had a move of about 2 basis points lower on the day, about 7 to 8 basis points on the week. We should point out the 2-year yield, though, the more rate-sensitive part of the yield curve, Fed-sensitive part of the yield curve, that's still staying elevated here on the week, up for a second straight week, those yields.
Hey, you guys remember congestion pricing?
No. Did it ever happen?
It did never happen.
I saw they put up these big things around New York. They're like these tolls.
They spent most of their money on that.
Did they ever turn them on?
They did not turn them on.
Oh.
Yeah, there was
So we
this
wasted money on
abrupt
that?
shift by Governor Kathy Hochul just a few months ago. Well, it turns out that Politico is reporting maybe there's going to be a revival of this plan. It's going to be a little different, though, than the $15 to enter certain parts of Manhattan now that the election has passed, Jess. And they're looking at, what, $9
That's
polls,
right.
perhaps?
So looking at
Bargain.
$9 poll
$9.
here, according to one of the people that the story said, and it was an MTA board member. So $9. So that would actually, the plan would lower it by 15 and would obviously require a lengthy environmental review.
Of course it would. Of course it would.
Well, no. Well, this is my understanding is that there's this range from $9 to $23. So since it's at the lowest end of the range, maybe the Hochul administration and the MTA can avoid another lengthy environmental review, and they could implement this before Trump actually goes to the White House, because there's some federal concerns too.
That's a really compressed timeline for a municipal government or in a state government. But the other thing that we need to keep in mind is they had all these exemptions carved out for people, right? Does that change if the toll is something different? And can the MTA still sell bonds tied to the revenue coming in for all this congestion pricing?
And that's the thing I think gets lost on this. I mean, we all could be outraged about tolls, but at the end of the day, this was money that was really supposed to go to improve the subway system here in New York. I don't know the last time you folks have been on the subway, but
each and every day.
I could say this was constantly
Charlie
confidence.
Pellet.
It needs improvement.
Yeah, it does need some improvement. Something else that we've been tracking here is, of course, the rally in financials on the election of Donald Trump. He's seen as positive for the sector overall because of deal making and, of course, lower regulation, consolidation in the industry. But on a personal level, for a lot of the CEOs at these firms, it's going to be really good news because if their stock continues to move up, they have bonuses that are tied to certain stock levels.
Yeah.
And so someone like Harvey Schwartz could get more money in his bonus, his discretionary pay, if the stock moves a certain level.
Yeah,
Another 10%.
Good for him. I mean, look, get your money. I don't think these guys needed it, but it gets to this idea, though, too, of kind of the industries that we know or at least have a good insights that are going to benefit here potentially from the Trump administration. And I think that's a big part of the price action that we've seen, Tim, over the last 3 days.
So $9 versus $15 for these guys doesn't really matter?
I'm not sure they're thinking about that.
Control?
Yeah.
Okay.
Yeah. Tim, you don't drive anyway, right? You just bike everywhere.
Bike and walk and take the subway. It's New York. It's too crowded to drive.
Thank you. That's what I tell.
It's too crowded.
Yeah, y'all don't
Too
want me
much
driving on the
traffic.
streets.
Too much traffic. Hey, guys, congratulations on a big week. Romain, good to have you back.
Survived it.
Yeah, thank you. Yeah.
We did.
I think I've counted up, Tim. I think I got about 6.5 hours of sleep all week long.
Well, I hope you get some rest
In
this
total.
weekend. It was nice checking in with you from Michigan over these past few days.
I drank a whole bottle of wine last night.
As you should. Well deserved.
Not even the weekend yet. All right. Well, good to see you guys. That is going to do it for our cross-platform coverage. Have a great weekend, everyone. We'll see you right back here, same time, same place on Monday.
All right, a lot more coverage coming up here on the big program, a deeper dive into what a new Trump administration will look like as we start to get some trickle of news about potential cabinet members. A conversation up ahead with Ed Mills, Washington policy analyst over at Raymond James. That's coming up next right here on The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romain Bostic. A wild week.
Yeah.
That might be the understatement
Exhausting
here
week.
of the week here. An exhausting week for politics, an exhausting week, though, for the markets, but it actually ends on a very positive note here. Only 0.4% gain on the S&P 500, but that really kind of obscures the fact that right now we're sitting on the best gains of the year for the S&P on a weekly basis, up about 5%. A record high for the S&P, a record high for the Dow Jones Industrial Average, a record high for the NASDAQ, and the Russell 2000 for the first time in 3 years, coming just about 40 points away from reclaiming another record high. Another record high for Bitcoin as well here. Basically, this was a risk-on type of week, certainly once we got past Tuesday.
Yeah, and really emblematic of the Trump trade. So I want to go into a couple of Trump trades for you today. You've got Tesla closing up 8%. In fact, back to a $1 trillion market cap for the first time since 2022. And the thinking here is that Elon Musk, the CEO's new BFF, Donald Trump, will be a positive force for the company and therefore for the stock. DJT, this is Trump Media and Technology, the owner of Truth Social, climbing 15% on the day, ever volatile during trading today. It was halted from trading at one point, but it did finish higher by 15%. The president-elect says he doesn't plan to sell shares of the social media network of Truth Social. But our top story this hour broadens out from that and builds on this story because personnel has become policy. Donald Trump won the presidential election with a clear mandate to enact his pro-growth agenda of tax cuts, tariffs, and deregulation. And a key tell for policy outcomes will be who is asked to serve. According to reports, Robert Lighthizer has been tapped to run U.S. trade policy, while Linda McMahon will likely be offered the post of Commerce Secretary. Both are veterans of Trump's first administration. Romain?
All right, and we already do know that the president-elect has tapped campaign manager Susie Wiles as his chief of staff here. And we're also getting reports about some other folks as well, getting a better sense here of what this new administration is going to look like when Trump is formally sworn into office in January. Ed Mills is joining us right now at Raymond James, a Washington policy analyst for that great firm. And I do want to talk about kind of the complexion of what this cabinet and these high-level officials are going to look like. Mills, do we have a sense of whether this is going to look very similar to the cabinet that he had back in 2016 when he came into office, or do you think there'll be a material difference in the type of folks selected?
Well, Romain, there's going to be repeats, and we saw that with Bob Lighthizer, but there's going to be a lot of new individuals. Probably one of the biggest difference we've been telling clients at Raymond James between 2016 and 2025 is that the Trump team has prepared this time. Back in 2016, they did not anticipate to win. They did not have a fully fleshed out transition team. This time, they have a lot of folks, especially at those sub-cabinet levels, who will do the work, who are ready to hit the ground running. And they have much more plans fleshed out as well for what their agenda could be in 2025. And so from that perspective, I do expect it to be much more robust in the first 100 days than it was back in 2017.
And we'd be remiss in not pointing out that, of course, Donald Trump's party, the Republican Party, we know now will have control of the Senate. And while we don't necessarily know the outcome of the House of Representatives, it's possible the Republicans could control the House. And even if they don't control it, Ed, the Democratic majority would be razor thin.
Yeah, but what I'd look at too, Romain, is if there is a Republican majority, that's a fundamentally big difference, but it's probably in that 218 to 220 range, and it takes 218 votes to have a majority. Go back to 2017, Republicans had a 47-seat majority. There's a big difference between having a majority and the ability to govern.
So one thing that I want to ask you about is Howard Lutnick, the CEO of Cantor Fitzgerald. He's been heading up the Trump transition team and has talked about how he is really taking resumes and wants to attract the best and the brightest from Wall Street. Do you expect a big exodus from investment banks to go over to the new administration?
Scarlett, I don't know if I'd call it an exodus, but would I expect a lot of folks from Wall Street to end up in this administration? Absolutely. I do think that when I've talked to a lot of individuals I've known who worked for Donald Trump during his first term, they're interested and optimistic about going into a second term. And that's part of why we've told folks at Raymond James that there is going to be a lot more earlier, especially if they complete that sweep. And I do think that there's going to be a number of picks that when Wall Street looks at it are going to be generally favorable to what they want as an outcome.
And of course, Scott Bessent, who runs macro hedge fund Key Square Capital, has really been, his name's been floated for a couple of different things, primarily Treasury Secretary. What can you tell us about his stance on federal debt, deficit spending, and how that may play into how the Trump administration pursues economic policy?
So I think where he's made the most headlines is about what he would think about doing at the Federal Reserve. We heard from Chairman Powell yesterday that if he was asked to leave, he would say no, and that he doesn't think that this is something subject to the law. What I am really interested in, if whoever is Treasury Secretary, can they have a strong relationship with the Fed chairman? Because Mnuchin and Powell had a good back channel that despite a lot of those attacks about Powell by Trump during his first term, he was able to smooth that out. If we have someone who is suggesting a different person at the Fed and maybe trying to have a shadow Fed, that raises a lot of market concerns, and that could raise a sense that there is a push to get Powell out sooner rather than later, even if he doesn't want it. Does he resign? Is there someone that goes on there who's more dovish? Do we see a bond market reaction to those questions? Put aside what we might do on tax cuts, and that's where the debt and deficit conversation absolutely comes up, Scarlett.
Absolutely. And when we talk about at least the markets maybe warming to the idea of some of the names being floated out there, at least for some of those key economic and policy positions, I am curious as well, Ed, it gets into this idea of the longevity of cabinet members. We saw a lot of churn, if you will, during Trump's first term back in from 2016 through 2020. And I am wondering, given the types of names that are out there and given the fact that Trump is now a seasoned let's just call it a seasoned politician as opposed to 2016 where he's kind of a novice here. Do we anticipate we'll see a little bit more stability in those positions once they are selected and confirmed?
It's an important question, Romain. I do think with the selection of Susie Wiles as his chief of staff, there was a sense that on the campaign she was able to provide greater stability, greater infrastructure. Will she bring that to the West Wing? Will she be able to have that as part of this administration? Those are significantly open questions. I don't think Donald Trump has changed who he is. So we would be looking at a number of these cabinet posts and other Senate confirmations as if you were in line for one of these jobs, there might be another job opening down the line. That's particularly important when we look at the House of Representatives. if the House only has a 1 or 2 seat majority, a number of the House members who would like to join the administration probably just can't, because it would threaten the opportunity to turn a Republican majority into a Democratic majority, which I just don't see coming. Ultimately, we'll have to watch to see exactly how long individuals stay. Folks like Steven Mnuchin, they were there all 4 years. Others were only there for as short as 11 days.
Yeah, good point. Do you think Mnuchin will make a comeback here? Will serve any kind of role?
I think he'll be a top advisor. There's no indication that there was a true falling out. It's been interesting to see that Mnuchin has not been part of the conversation about Treasury Secretary, where we've seen others that have come in.
Yeah.
But it seems like he's pretty happy outside of government at this time. He put in his full 4 years.
All right, Ed Mills, thank you so much. Ed Mills is Washington policy analyst over at Raymond James. Now, we're going to stay on this topic because coming up, Silicon Valley also bracing for Trump's White House return. That conversation next on how the CEOs there are positioning themselves. This is The Close on Bloomberg. The future of big tech in focus with Trump 2.0 on deck. A procession of tech CEOs have been taking to social media, pledging to work with the president-elect to boost American innovation. This is in stark contrast to 2016. Bloomberg opinion technology columnist Dave Lee joins us now to discuss. And these CEOs who are talking about, first of all, congratulating President Trump on his election. Are they being pragmatic, or is there a real affinity that's developed between the industry and the president-elect?
I think it's mostly pragmatism. I mean, they need to work with Trump. They need to be on his good side, shall we say. And we've, seen reports where CEOs have been calling Trump to congratulate him, or before, just to talk about issues. We know Tim Cook's done that at Apple. We know that Satya Nadella at Microsoft has done that. We did see some of this in 2016 at the very beginning. There were congratulatory tweets and so forth, but it quickly changed once some of Trump's policy started sort of bearing fruit, as it were, particularly when it comes to, there was the travel ban in 2017, and I was there at San Francisco airport when there was hundreds of people protesting, including the likes of Sergey Brin at Google and Sam Altman as well.
Well, that's what I'm curious about, too. I understand why any corporate CEO would want to embrace whoever is in power. I mean, that's always been the trend. I mean, usually they try to play both sides in anticipation of it. But we also know that a lot of the pressure that came on those companies during 2016 was from their employees and from their customers. So if we do see a repeat of what we saw in 2016 and we see that pressure come, do those employees and do those customers still have the same clout to force the hand of these companies to take whatever position they want?
I think it's a very different Silicon Valley right now. I mean, they're still counting votes in California, but like the rest of the country, there has been a swing to the right. I don't think there's as defined a unit of tech employees that say this is bad and this is good. Last time we saw, the CEOs come out, and you had at Google, there was rallies that were sanctioned by the management. Employees were allowed to take time off and join things. I don't think we'll see that this time around because it's a much more complicated picture. I was talking to a person who was involved in a lot of work or organising in 2016 and beyond, and he was saying he expects there to be less public resistance from tech employees and perhaps more whistleblowing and other sort of more covert
because we've seen the consequences of that just recently here, particularly with Alphabet and a few others that have basically said, look, we're not doing this anymore. Like, we gave you a little bit of a pass during the pandemic and during George Floyd stuff, but now they're like, we've moved on and we don't want to see that.
The labor market's a lot tighter now, so the employers have a much more sway and much more heft. What does this mean when it comes to Trump's stated preference to deport illegal immigrants? Because a lot of these Silicon Valley companies have a hard time attracting the right talent.
Well, where this perhaps differs from 2016, 2017 is the mass deportation plan would probably affect people working at those companies, but in lower paid jobs. So people working in the kitchens and people, cleaning these offices, compared to the travel ban, which affected many companies where top engineering talent would come from. And that's where many of these CEOs came out and said, these are, talented individuals that we need to develop our software. It'd be interesting to see whether that dynamic makes a difference to how the tech companies push back against the Trump administration. I think what's potentially interesting as well is, there are billions of dollars on the table in terms of AI opportunities and other, needs that the Trump administration is looking to push forward. If you're Google and you're Facebook and you're Microsoft and you're going, how do we get the return on investment on this enormous expenditure we're going to for AI? Yeah. Well, government contracts is it. I mean, that's where you're going to get this stuff. So I think, if you're talking about doing the right thing for shareholders, I've got a feeling turning something of a blind eye this time is going to be the more sensible, for want of a better word, take that the CEOs might follow.
Yeah, and it's kind of interesting too. I think we have to leave it there, David. I am curious. We have to talk at some point too, also about kind of the connection this administration is going to have with Peter Thiel and that whole organization, and the idea that he has a lot of companies that I assume he's going to want to make sure have some benefits out of this administration. Dave Lee, Bloomberg Opinion, technology columnist for us here. When we come back after the break, we're going to continue our focus here on the re-election of President Donald Trump and speak to the author of Picking Presidents. We're going to actually talk to him not only just about Trump's victory here, but some of the forces really that led us to where we are today. Stick with us. This is The Close on Bloomberg. All right, President-elect Donald Trump will be sworn into office for a second term as President of the United States. That's scheduled to happen in late January. Let's discuss someone who literally wrote a book on this subject. Gautam Mukunda is the author of Picking Presidents, How to Make the Most Consequential Decision in the World. He's a lecturer of management practice at the Yale School of Management, and he joins us right now. Well, we did pick a president here. It is a former president, if you will, here. And I do want to start right there because we talk about election cycles here in the United States, presidential election cycles, and the idea that people tend to look at the incumbent and say, we want to change. Maybe that's what hurt Trump when he ran for re-election back in 2020. Maybe that's what hurt Harris to a certain extent because of her association with the current administration. What's your take?
So I think that's very, very much the case. And I'd say if you only paid attention to one factor, that's the factor you pay attention to. So political scientists have looked at every single incumbent party around the world that has run for re-election this year. And every single one of them lost vote share compared to the last time they ran for election. Every single one. We have data that goes back all the way to 1905, and that is the first time that has ever happened. So your baseline expectation of this campaign should be that the incumbent party, Harris, who represents the incumbent party, is going to get hammered. What we saw essentially was a broad secular shift across demographics, across states, everywhere you want to look at. It happened about 6% to Trump. The exception of that was in the swing states, where what we saw was about 3% to Trump. That's a significant shift in a country as balanced as the United States. It's enough to hand him a decisive victory. But it also suggests that given that the swing states were where the campaigns were focused, that the Democratic campaign wasn't so much ineffective as just had too steep a hill to climb.
Absolutely. And but I want to focus also, too, this idea that once Trump does take office, he is coming into office in a much different way than when he came into 2016. He has a mandate. I know there are a lot of people in this country that are just absolutely just upset about that fact. But when you look at the margin of victory on a state by state, on a national level, the fact that the Republicans now have control of the Senate and could potentially control the House, he has a mandate to do what he wants. What is that leadership going to look like this time around, and how does it differ from his previous presidency?
So he will definitely say that he has a mandate. I'll just say I'm happy to answer that, but I just want to point out, by the margins of presidential victories, this is not a big landslide. Obama in 2008 was a huge landslide. And Mitch McConnell's response was not to say he has a mandate for change. It was to say his first priority was to stop President Obama from being elected. So Democrats have a choice. They can say, well, this is a mandate and we're going to go along with it. Or they can say, we're going to do what the Republicans did successfully and we're just going to go to the wall in opposition. Which one of those they pick is up to them, right? So it's just key to remember that bit of history. As to what we think he will do, we can sort of split out, right? So there's stuff he can do through executive action quite quickly. Tariffs, different changes in foreign policy. The one that I'm really watching is the revocation of Schedule F, which is an administrative rule that protects the upper ranks of the civil service from being replaced on political whim. So the upper levels of the U.S. government have large numbers of people who have worked their way up to the civil service and have large amounts of technical skill and sort of a lot of expertise. And if they can be replaced by the president, you're looking at a fundamentally different U.S. government from the one that we've had for about a century now.
And that's really important also, considering the New York Times has a headline, Gautam, about how the Trump team is considering relocating the EPA, for instance, out of Washington, D.C., moving an entire agency to another place. What does that, I mean, that's another way of essentially changing the personnel completely, wholesale, right? Like getting rid of a whole class of employees and bringing in your own people.
It is, and it's more than that. The federal government has the highest, in terms of the education of the people who work for it, it has the highest human capital of any large organization in the world, right? That is just an empirical fact. Mm-hmm. So these are people who have choices, right? If you were a senior staff scientist at the EPA and you decide you don't want to move to wherever they move the headquarters, DuPont's, like Dow Chemicals is going to want to hire you. You're going to have lots of options. And so two things will happen. One is you'll have this huge turnover and replacement with your own people. But the second is you're going to get people who don't have the experience and quite often don't have the skill set to do this incredibly complicated technical work. Yeah. I think the best book on this is actually by Michael Lewis, is The Fifth Risk, where he just takes a few verticals of things the federal government does and tells you how insanely complicated they are.
Right.
If we can't manage those problems, the U.S. government sort of like underpins a lot of our life in the way that we don't always appreciate, and manages technical issues that are so vast they generally don't break into the horizon of the news, right? But
certainly,
if you're thinking about how to manage nuclear fuel that has to be reprocessed, or how to predict hurricanes, it takes a lot of skill to do that.
Gautam, very quickly here, what's going to happen next? Because you point out that the fundamental driver of U.S. politics is that they're thermostatic, which means that public opinion, it's only a matter of time before it shifts away and opposes Trump.
That's right. So whatever a president does, the public reacts against it. That is like the basic force of American politics. So whatever you do becomes unpopular. And 10 years later, you might get credit. It might become popular, but in the moment, it is just about always unpopular. So what that means is, for stuff that he wants to do that takes significant public support, he's got about 18 months. Mm-hmm. And he's going to have to organize, people to do that. He'll have a very thin margin in the House. And some of the stuff that he's proposed doing is stuff that will get extraordinary levels of public pushback, right? Like they propose major changes in the way Social Security, Medicare, and Medicaid are handled.
Yeah.
But like touching Social Security we call it the third rail of American politics for a reason, right? You touch it and you die. So that's going to be pretty difficult to do. The tariffs are equally likely to have sort of significant political pushback.
Right.
Just think about all the exporters who are going to be dealing with the retaliatory tariffs, or the manufacturers who are doing with something similar. Yeah.
Gautam, really appreciate your taking the time to speak with us. Gautam Mukunda is lecturer of management practice at the Yale School of Management. He is also author of Picking Presidents, How to Make the Most Consequential Decision in the World. And as we head to a commercial break, just a quick recap here of the markets, especially as we head into a three-day weekend for the bond market because it is Veterans Day. You have the S&P 500 climbing above 6,000 but not closing there. Nevertheless, this is a record high. The 10-year yield droops down and actually falls for the week to 4.30%. Dollar strengthens. That's been the trend for a while now. And oil prices losing about 2.5%. This is The Close on Bloomberg. From the clothing we wear to the curtains in our homes, the U.S. and India are some of the world's top contributors to the global textile trade. About 6% of U.S. textile imports comes from India, making it our third largest partner in the space. And that share is expected to grow. Data estimates that India's exports to the U.S. will reach $65 billion by 2026. Of course, these numbers are subject to change depending on what the new administration decides to do. Here in studio now to offer firsthand insight into that relationship with the Indian textile industry is Dipali Goenka. She is CEO and Managing Director of Welspun Living. It is one of the largest textile companies in India. Welcome.
Thank you. A pleasure indeed to be here.
So Dipali, the fog of uncertainty, at least for an investor, has been lifted with the clear outcome of this election. Do you feel that there's now more clarity and certainty on the U.S.'s stance on imports from countries like India?
I think so too, because India has been at the integral part of the supply chain for all the global retailers for a long, long time. I mean, for the last 2 years, we saw that momentum come in a lot, and we saw businesses will increase and the market share increase as well. And I feel there would be that kind of interest in India because India is, investing in infrastructure, investing in people, upskilling people. So it's becoming a huge opportunity for India.
It's also an opportunity because India is pointedly not China, and that's something that's been said over and over again. The lesson learned from the unexpected election of Trump in 2016 was that take what he says seriously, but not literally. He said a lot about trade with our Asian partners and tariffs. During the election, of course, this week as well. From where you sit, what do you take seriously? What do you take literally?
We'll wait for that, how it, can't speculate on that right now, but I can say we've been working with the United States of America for over 2 decades, seen several administrations, and have seen the COVID. So we are a resilient company and can also say that, India has had good relationships with the United States.
It has had good relationships with the United States. And 2023, it was kind of a bit of, 2024, sorry. It was a bit of a kind of coming out party, if you will, at least for a lot of folks outside of India to kind of see the rounds that Modi made, of course, a very momentous trip here in the U.S. And the idea that investors, foreign investors, seem to have really sort of warmed to the idea that this might be a place of opportunity. When we talk about the investability of India as a foreign investor here, how easier is that going to get?
India is the country. I must tell you that it is in a sweet spot. Let me tell you that. The most stable democracy, and the development there is really catching up. I mean, the infrastructure, the investment in people, the investment in, chips, as, you see the Apple coming up there, automobiles. It is surely going to be one of the largest economy as we go forward.
Has there been discussion, and we know India and really largely Southeast Asia has always been a big supplier in the textile space here. Yeah. The sort of higher end electronics is something that is relatively new, and we've seen with the rollout of the iPhone 16 that India has shown that at least in certain capacity is certainly as capable as China there. How do you avoid, though, India, and by you, I mean India as a whole, avoid some of the mistakes maybe that China made in its relationship with the United States?
I think India is a fast learner, and they've been doing it. They're deploying a lot of experts there. And I can see that happening very fast because I've been watching it from close quarters as being one of the leading industrialists and a leading company because we have invested not only in textiles in India, but also in infrastructure. We're building roads and highways, and also oil and gas and hydrogen, green hydrogen as well as a company. So,
but do you worry about the tariff situation here in the U.S.? And I know a lot of those tariffs are more directed towards China and other nations rather than India, but there is a blanket effect to some of those tariffs that I would think at some point would affect industries in India, including yours.
I would say we'll cross the bridge when it comes in, but I think as an opportunity, India really has a great opportunity. And we'll definitely see a lot of big things happening to this country. And because I'll tell you about Welspun. We started with bath over 2 decades back, and today we are a home solution company. America contributes around 63% to our top line, so yes.
And the stated intention of those tariffs is to bring U.S. manufacturing jobs back home. Welspun has actually a new manufacturing factory in Ohio. It's to make pillows, I believe. You just launched this recently. What was the biggest challenge when it came to setting this up in terms of regulation, insurance, or even hiring?
You know what? It has been so smooth. And people have been so welcoming here. We set up this plant in Ohio, and we've got the complete support from the administration there. And it is also encouraging us to set up a couple of them. We're exploring opportunities in the United States of America because we feel sleep is a very big challenge in this country. And coming on shore to set up a plant is going to be interesting.
You said sleep is a very big challenge for this guy. Well, I mean,
this is true.
It's certainly in my household, and certainly this week. And seriously, where's the growth opportunity for you? We only have about a minute left, but for Welspun, what's the growth opportunity here in the U.S.?
It's all across the categories because, as I said, we started with bath, but we're also doing bedding, fashion, rugs, carpets, and flooring. So we have all the categories across, and I see that as a great opportunity. And I think America, actually consumes 30% of the world's textiles.
Okay.
And there's nobody as big as America.
Thank you. I appreciate that.
The world's best customers.
We are the world's best customers. Dipali, a great conversation and great to meet you. Dipali Goenka is the CEO and Managing Director of Welspun Living. Stick with us. A lot more coming up here on the big program, including setting you up for some of the big market-moving events over the next week. This is Bloomberg. Yeah, remember when it cost an arm and a leg just to buy a used car? Well, new data out there shows the prices have actually been decreasing, including in October from the month prior, and are now down more than 3% on a year-over-year basis. Here to talk about some of those trends in the used car market is George Chamoun. He's the CEO of a company called ACV. It's a digital platform for dealers to buy and sell used cars. Thanks for being here, George.
No, thank you for having me. Really appreciate it.
I think we all remember those halcyon days, at least for those folks who were selling used cars, where you can basically, name your price and get everything. We've seen a moderation in that, or maybe a renormalization of the market. Give us a sense here at the wholesale level, dealers coming in, looking to buy. Are the prices much more competitive now than what they were, maybe 4 years ago?
Yes, certainly. I mean, used car values have continued to come down over the last couple of years. Affordability from consumers obviously has been a big challenge, and we've seen prices come down. A big part of that is as new supply comes back and the incentives for new, think about now all of a sudden there's great lease payments for a lot of the great vehicles out there. So as the new lease incentives come out, new prices come down, used car values also come down.
Give me a sense here, too, with ACV, because you're dealing mainly with dealers. It's basically a wholesale network, more or less here. The types of dealers you're dealing with, are these kind of single one-off dealers? Hey, I got my, Joe Blow's Ford, on Route 96. Or are these more kind of those big kind of multi-brand dealerships that kind of sell everything under the sun?
Yeah, at ACV, we work with both. We have some of the largest dealers in the country leveraging our products. We have several products. One is ACV Auctions, and we also have a product that helps dealers source cars from consumers. And 1/3 of all of those new car or franchise dealers are working with ACV. In addition, independent dealers, as you mentioned, are a big part of the independent used car sales. We probably have around 1/3 of the independents or more working with ACV as well.
What kind of demand is there for hybrids versus EVs versus ICE vehicles?
So there's definitely today the highest demand for ICE, but plug-in hybrids.
Because of the price point.
Price point, trust, comfort, electric vehicles, especially dealers buying these cars after, if you think about our network, our network of dealers are comfortable buying these. So we've seen residuals did come down early in the year quite a bit with electric. It kind of leveled out, then just came down a little bit more. Plug-in hybrids have stayed very strong.
Yeah. I ask because a lot of people are leasing EVs right now. It's a way of testing out whether they want to permanently adopt this. And that means in about 3 years, there's going to be a lot of supply coming onto market, maybe even too much, given, it's been a slow transition to EVs from ICE vehicles.
Yeah, I just think all this stuff levels this stuff out. Every single one of these cars will get purchased at the end of the lease, at the end of its term. It just then corrects the price. So every one of these, there's a transaction price for every one of these assets, and we're obviously seeing now a lot more incentives for new EVs, and that will also drive the prices down.
Are expectations, though, consumer expectations, and dealer expectations for that matter, kind of a little bit normal in terms of pricing? Because there was a big disparity there, not just in used cars, but we saw that in new cars as well. I'm just wondering, have we gotten more in alignment?
There's definitely more alignment, but there's gaps of vehicles that dealers will definitely pay all the money for certain cars. There's many consumers out there. Keep in mind, the age of vehicles today on the road is 11 years old, average age, highest it's ever been. So many consumers are sitting on vehicles that they would be surprised what dealers will pay for these cars. And we power these trade-in tools for well over 1,000 dealers across the country, where consumer right in their driveway can put in their data, take pictures using our artificial intelligence, and get a number. And the number is actually pretty high. And so you've seen all the media on prices have come down, but there's still a lot of consumers out there, especially the consumers that bought cars 5 years and prior, have incredible equity in these vehicles.
How do you see demand from consumers to upgrade their vehicles or to trade in their vehicles changing if interest rates continue to decline, albeit a little bit more slowly than perhaps people had projected at this, earlier this month?
Yeah, the cost of capital drives obviously both new and used affordability opportunities. So we're already seeing it with new. So as you've seen interest rates come down, you're seeing the OEMs lean in on incentives as their cost of capital goes down. And on used, the same thing will happen. So all of this, at the end of the day, the everyday household is thinking about a monthly payment. So whether they buy a $25,000 car or a $30,000 car, they're thinking, how do I pay $300 or $350 a month?
It's like they reverse engineer it.
That's right. And so we're already seeing new get corrected. Used prices are going down. As interest rates go down, it's going to be a really big factor for the everyday consumer to be able to buy these vehicles.
What's the growth story for ACV going forward? I mean, you guys have come a long way in a very short time, and a lot of people don't even know your name. I mean, they might be familiar with the product here. Is there sort of a plan in place, I guess, to not only just broaden the business, but also just broaden the awareness of it?
Yeah, our objective is we think both new car dealers and independent car dealers have unbelievable locations across the country. So think new car dealers, there's 16,500 locations. As you all drive by these BMW stores, Mercedes stores, Ford stores, they need technology.
Yeah.
They need the tools. They want to compete against those big box companies that come on to shows like this.
Yeah.
And we're here to help them. So think about ACV and some of our products like ClearCar are enabling technologies, so think B to B to C, so that when the everyday consumer wants transparency and trust on the value of their vehicle, they're going to be able to go to that local dealer, start in their driveway, show up, know the value of their car, and we're the ones going to be powering that.
All right, George, going to have to leave it there. Great conversation and a great product. George Chamoun is the CEO of ACV. As we round out the show here on this Friday and, well, for the week, let's set you up for what could be a busy week next week. Though not on Monday, Scarlett. It's Veterans Day.
Yeah, so the bond market's closed.
The bond market is closed, and I think they need a little bit of a break, given all the activity that we had over the last 3 days here.
Over the last couple of weeks, right? There is going to be an APEC forum day one where CEOs and leaders gather. Also, a special parliamentary session in Japan to select a new prime minister, which is key for the Forex market.
We'll be keeping an eye on that. Then on Tuesday, we'll be keeping an eye on an OPEC Plus report, and more importantly, on a slew of earnings that could provide a little bit more insight on the economy.
Certainly, and on the consumer, Home Depot, Shopify, Hertz, and Kava Group as well, which has done phenomenally well.
Don't forget Tyson.
And Tyson, yes.
Are you against chicken?
No, love chicken.
Okay, all right. And then on Wednesday here, I think the big thing on Wednesday is probably going to be that CPI report. And I know the Fed's done their meeting, they've moved on, but a lot of people paying attention.
And a lot of people worried about the incoming president's policies perhaps being inflationary down the road. There's also Cisco and Rakuten earnings that day.
And then on Thursday, we get the PPI numbers and initial jobless claims and more earnings, including from the mouse.
Yeah, Disney is going to be reporting a lot of questions about streaming, profitability, whether they're still on target to meet their goals, and of course, any commentary on CEO succession. Ooh.
Yeah, ooh, and then of course, let's just take a quick look at Friday here, rounding out retail sales, Empire Manufacturing and Industrial Production, and earnings out of Williams-Sonoma.
There's another read on high-end consumer spending.
Yeah, absolutely. Have you ever seen their catalog for the holidays where they sell the $100, peppermint bark or something like that?
I know.
Yeah, what's the profit margin of that? All right, that does it for us here on The Close. Thanks for joining us this week. Always appreciate it. We'll be back next week. This is Bloomberg.